Assalamu alaikum and a very good day to all viewers out there. I am Yusnaliza. Welcome to my channel. Today we are going to discuss question common test MFRS 116, which is equivalent to IAS 16 on property, plant and equipment. This is question 3 October 2018 from the subject, the course code FAR210, which is Financial Accounting 3. Financial Accounting 3 is offered at the UITM. Okay, let's start. Riverside Food Berhad started a food processing business. Food processing business is the business activities of the Riverside. Riverside Food Berhad is the reporting entity or the entity that prepares the financial statement. The food processing business is the business activities. These are the business activities, or maybe the main business activities of the company. And that was business started on 1st of July. The company bought 2 food processing machines. So what was bought was two machines, and the machine cost 70,000 each on 1st of August. So the 70,000 is the purchase price per unit. 1st of August is the date of acquisition. The company also incurred transportation costs. Transportation costs, if you recall from the lecture, these are part of the directly attributable costs component, which is incurred to bring the asset, here the asset is the machine, to its intended location for its intended working condition, which is to serve as a food processing machine. And that transportation cost was actually for both machines. So that is directly attributable cost. Directly attributable costs will be actually included in the initial cost. This will also be included in the initial cost. But you need to be extra careful with the machine, because some of the costs are related to one machine, whereas some related to 2 machines. But here in transportation, 3,000 are for both machines. You also have an installation cost. Installation cost is also an example of directly attributable cost, because you need to install a machine. You need to test the machine. So before you can test the machine whether it functions well or not, you need to go and install, and that costs them, the company Riverside, 3,500. And that was 3,500 each. So each means if it's for 2 machines, you need to pay installation cost of 3,500. And the maintenance cost was 2,500. Okay, for this maintenance cost, these are not part of directly attributable costs, but this is actually the costs that are being excluded. Costs that are excluded. Costs that are excluded from the initial cost, because that cost is just to maintain the machine so that it will be working properly, right? And that is the day-to-day expenses of the company. Maybe it has to be incurred, maybe every year, has to be incurred every month to maintain the machine. All costs incurred has been paid. It has been paid means things have been, these are using cash. So this is actually purchase of machine for cash. So that was being paid upon delivery. So it was settled. So by the time the delivery of machine were being made to the Riverside Food Berhad, that gives the control, or the resources are under the control of Riverside Food Berhad. and they have the right to use the machine. Company adopt depreciation policy. So depreciation policy, here is, if you can still recall, there are two methods that we learn. One is straight line, another one is reducing balance method. And this company adopts straight line method, calculated on monthly basis. There are two bases that you learn. One is yearly, another one is monthly, right? So these are the basis, and these are the method. So the method here is straight line, the basis is monthly, and the rate is 20% per annum. 20% is the percentage. Sometimes you may not be given the rate, and if it's 20% per annum, it will be fully depreciated by the end of the 5 years. So that is why at the bottom here you are informed useful life is 5 years. So if it's 20%, it will be fully depreciated in 5 years. So if you say if it's 25%, that will be fully depreciated in 4 years, right? If it's 10%, that will be fully depreciated in 10 years. So that one is just to show you how do you convert the percentage into useful life. So the expected useful life, EUL. And the closing date of the company is 30th June. So if it's 30th June, which is the financial year end, it starts on 1st of July. Yeah, 1st of July 2017, because you can see the information given later, and it will stop on 30th of June 2018, right? But you need to also check what are the period that the question asks you to prepare your accounts or your calculation for. Next. Okay, before we are asked to do all the calculation side of the question, you are asked the theoretical part, which is asking you to state the recognition criteria for an asset in accordance with conceptual framework. So in our case here, in general, right, that one is in accordance with the conceptual framework for the financial reporting. So let's see what are going to be the answer. So because we are discussing the part for our question on MFRS 116, the recognition criteria here is, if you can still recall, probable future economic benefits. Probable future economic benefits, meaning that there will be an increase in income, like maybe sales, right? Increase in income will normally also be evidenced by way of increase in cash, because if there is increase in sales, of course cash will increase if you receive the payment. Associated will flow here refers to the increase in cash. Future economic benefits will normally be related to income sales. Next, the cost of the asset can be reliably measured, meaning that you know how much is the amount of the initial cost. So can be measured reliably. How much is the amount here is how much is the amount of the initial cost. So you know, and this one fulfill again the faithful representation side of the conceptual framework. And the first point here, fulfill this one, right? Fulfill the relevant side of the framework, which is the fundamental qualitative characteristic. Next, explain briefly, explained whether the food processing machine can be classified. Okay, the word here can be classified, meaning that it's about classification of the machine, whether it fulfills or it meets the definition of PPE under MFRS 116. So if you talk about classification, that one has something to do with looking at, if it's an asset, we are asking which MFRS applies to the machine, right? So which MFRS, or where should we account? Under, it should be recognized, under which MFRS, under the recognition, right? Basically that. Recognize under which MFRS. Okay. Next, so meaning that you need to relate to your definition. This question is about whether the definition is met. To know whether the definition is met, of course, you need to recall your definition of PPE. Definition of PPE. I think you can still recall definition is being met if there is a proof of it is a tangible item, a proof that you use for production P, supply of goods, supply of service, rental to others, and for admin purpose. Any of this, not necessarily all five, any one of this, and also being used for more than 1 year. That was the definition of PPE. So if it is a tangible item that is used for production, for supply of goods, for supply of service, for rental to others, or for admin purpose, any one of the five. So in our case, machines are items of property, plant and equipment. If we check the answer here, why? Because the food processing machine, which is the machine, has the physical form. Another word for tangible is physical form, or you can say there is a physical substance, physical existence. Tangible item, it is tangible item made of, maybe you can say made of steel, made of iron, for example. You can just add up that. They are held in the production. How do you know they are held in production? Because it was a food processing machine to produce or to process food to become a product, right? I'm not sure what was the food. Maybe canned food, for example. Processing machine, and the food that was to be held in the production. So it fulfilled the first part of the definition, also fulfilled the second part of the definition. First, second. Second part related to production, because it was a food processing production machine. So number 1 check, number 2 check. Now we go to number 3. We need to check whether the machine is being used more than one accounting period. So we need to write the sentence. The machine is to be used for more than accounting period. In our case, they are expected to be used for more than 1 year, which is 5 years. Okay, next. You are asked to, this part C, you are asked to differentiate between initial and subsequent costs. If you are asked to differentiate, you can either put them in sentence form, in paragraph, or you can also present your answer into a table. So you can draw your table. One is for initial cost. Another one is to explain the subsequent costs. And the points can be put under each table. Okay, let's say the first point for initial cost here, because the marks is only 2, don't write so long. Remember costs that you incurred before the asset is ready for use, or to bring the asset into its location for its proper working condition. The cost incurred here, if you can still recall, purchase price, directly attributable cost, and initial estimate of dismantling, restoration, and decommissioning. Right. So that one, but here we don't have to go into that diagram. We just to mention that whatever cost incurred before the asset is ready for use, and to bring the asset into its location with its proper working condition as intended by the management, and intended use. Intended use here is as deemed by, and just add a little bit more, and management, because management or the board of directors will decide. What that one is incurred normally on the date of acquisition. Subsequent cost is actually the cost that is incurred after the asset is ready for its intended use. Let's say the date of acquisition is here, right? 1st of January 2019. So whatever cost that you finalize here, let's say 100,000, the cost that you incurred after that throughout the useful life of the asset, that is subsequent cost. Or these are the costs incurred after the asset has been used or it is started to be used, or the cost that is going to be incurred over the useful life. So in our case here, useful life is 5 years. 1, 2, 3, 4, and 5. So in this 1, 2, 3, 4, 5 years, if you incur cost over that period, that is cost called subsequent cost. Either that one is to maintain the asset, repair, for example, replace some components, either just to maintain the asset, or maybe to upgrade the asset or improve the performance of the asset, so that would help to increase the value of the asset or the future economic benefits of the asset. Okay, next, D1. You asked to calculate the initial cost. Originally, earlier, based on the question, I already made this segregation. If you can still recall, the purchase price from the question, when I was explaining, it was 70,000 each. So we multiply by 2 because for 2 machines, so 140. Transportation cost, earlier, if you can still recall, this is for both. This one is each, right? So that's why you times 2, which is 70,000 times 2. Right? This for both, 3,000. Installation are also each to be 3,005. So you times 2. So the total will be 150. And this is your total initial cost that you will pay, because you paid in cash. So if you do that, right, you calculate the initial cost, that gets 150,000. Next part is that you are asked to compute the depreciation expenses. So if you can still recall, in our question earlier, I'm just going back to the part that you have already picked up a lot of things here. Straight line method, the one in blue ink here, in the light blue. Straight line method, depreciation policy, monthly basis, 20%. So I'm going to put that figure, that information into my calculation. And remember, the asset is having an initial cost of 150. So it is using straight line method. That straight line method has 20% on cost. On cost here it is based on depreciable costs. Depreciable cost or depreciable amount is cost minus residual or scrap value or salvage value. Okay, so, and then you are informed that the basis is monthly. So if the basis is monthly, you need to provide month-to-month depreciation. So depreciation is based on the month-to-month ownership, right? And when you say 20%, this means it's 5 years. I've already proven to you that. So this is straight line method. And if you look, the year end of the company was 30th June 2018. And the acquisition of the machine, if you recall, it was purchased somewhere, where was it? August. On a machine purchased August 2017. August 2017. Okay. So from 1st of August 2017, let me put that here for you, the timeline. So the year end is supposedly 1st of July 17 and ends 30th of June 18. However, you purchase your asset, your date of acquisition is 1st of August 17. From 1st of August until 30th of June, there is 11 months. So according to the monthly basis, this must be provided based on month of ownership. So therefore, the depreciation will be based on 150,000. In our case, the cost is 150,000, which refers to initial cost. The residual value or the scrap value or the salvage value is nil. So therefore, the depreciable cost or depreciable amount is also the same figure, 150,000. So for that particular year, which is only for the year ended 30th of June, the first year, it will be 150,000 times 20%, the percentage times the month ownership, so you get 27,500. And this one is your expenses. And you can later see in the next part of the question, you are asked to do the journal entry for that depreciation expenses. So you are asked to do the journal entry for whatever transaction, realize the transaction for the year ended, for the whatever transaction that you have in the information. So on 1st of August, this is the date of acquisition. You have the machine. This one is the initial cost, 150. You pay in cash. So increase in asset, increase in asset here, current asset and non-current asset, 150. And then the maintenance costs. Maintenance costs, remember, you have the maintenance cost, the total is 5,000. So this one is the one that I mentioned earlier, expense of debit to the SOPL as maintenance costs. The third one is the depreciation that we calculated, and remember this is for 1 year, starting from beginning of the year, but we do not provide beginning of the year. We provide that starting from 1st of August up till 30th of June, because you only purchase for 11 months and it's monthly basis. And depreciation expense here is depreciation expense related to the machine. Same goes here, accumulated depreciation related to the machine. So it's 27,500 from the previous answer. Okay, now the last part of the question is part E. Company owns piece of land. Land is a non-depreciable PPE. And this is the land where the food processing factory is located. So there is a factory and there is a land. Factory is of course the depreciable asset. The land was acquired. So the story here is about land acquired 5 years ago at a cost of 5.5 million 5 years ago. So 5 years ago. Okay, somewhere here. 5 years. Yeah. Ago. That was at 5.5 million. So the initial cost is 5.5 million. Yep. And the board of directors decided to do revaluation exercise. Revaluation exercise, they decided to do that. So this refers to the so-called subsequent measurement revaluation model. Okay. And they notice that there is a significant increase. The word significant increase means that there is a surplus on revaluation, because we use revaluation model. Significant increase in the value of the land. They agreed to incorporate the new value in the financial statement, and they have that year end 30th of June, and the revalued, this is important, the revalued amount of the land was 7.2. So compare the 7.2 with 5.5. 5.5 is your cost, right? But your cost will now be your carrying amount. Why cost is the carrying amount? Because land is non-depreciable asset, so there are no such thing as cost minus accumulated depreciation. So you have to discuss the subsequent measurement in valuing the land. So you are not asked to discuss any figure yet, but just about the subsequent measurement. So if you can still recall subsequent measurement, which is step 6, right? There are cost model and revaluation model. So you need to discuss this. Either you can put this in a table like this, side by side, or you can put that in a paragraph, bottom, top, right? Okay, so under cost model, if you recall, the cost model is about cost minus accumulated depreciation minus accumulated impairment loss. Accumulated impairment loss, AIL. Accumulated depreciation, I put this as AD, and shall be carried at cost. So under the cost model of, I put here CM, the carrying amount will be cost minus accumulated depreciation minus accumulated impairment loss. So the item of PPE shall be carried at cost. Cost less accumulated depreciation less accumulated impairment loss. And this is the carrying amount. The carrying amount is as a result of cost minus accumulated depreciation. Under the revaluation model, if the company adopt this, the PPE is being measured at its revalued amount. What is the revalued amount? Revalued amount under revaluation model is the fair value on the date of revaluation less subsequent accumulated depreciation and less subsequent accumulated impairment loss. I put sale, these two. And when you do this under revaluation model, this carrying amount is as a result of what you call, and this is what you call revalued amount. And under revaluation model, the asset is being measured at revalued amount. There shouldn't be extra L here, right? Under the cost model, the asset is being carried at cost less accumulated depreciation less accumulated impairment loss. So here, since there, how do you make conclusion? Since there is an increase in the value of the land, right? There was an increase. So you can give advice that revaluation model is the most appropriate. Why? This is stating your answer, but give the reason. Because it will reflect the current value or the market price of the land or the fair value of the land, right? So you just go and give your reason why it is appropriate, but state the point first. Next, you are asked to give advice on the accounting treatment. So advising the accounting treatment is to give some sentence form of advice. So that is to advise on 30th of June. So if you look, the cost of the land on the date of acquisition 5 years ago, that was 5.5 million. Of course, there is no accumulated depreciation because non-depreciable, right? So you have 5.5 to be the carrying amount. So that carrying amount equal cost, and you will compare with the revalued amount, which is the fair value given. Your fair value was 7.2 million. The difference is 1.7 million. This is your what you call revaluation surplus. Under MFRS 116, revaluation surplus, this one will be debited to the land and will be credited to ARR on land. I'm doing the journal entry for you. 1.7, 1.7. This is not required, but I'm doing extra answer for you, right? Revaluation surplus is 1.7 million, right? So that one is the calculation. How do we expect to have that in sentence? So you need to say there is an increase in the value of land. Why increase? Because it's a surplus or revaluation. Mention the surplus. So do this calculation, right? And show the workings. Okay, talk about the surplus. Then talk about the treatment. So this one is talking about the accounting treatment because it talks about recognize here in other comprehensive income. So when you debit the land, that increase the asset. But when you credit the ARR in your SOPL, under other comprehensive income, you need to disclose the figure 1.7 million. Whereas in the statement of changes in equity, under your asset revaluation reserve column, you need to also show 1.7 million. But this one is your disclosure. This one is your presentation, right? So the plus is recognized in other comprehensive income, which is disclosed in SOPL, and is credited to the asset revaluation reserve. So here we credit, right? Here. The revalued amount, what is the revalued amount? The 7.2 million here. This is the revalued amount. Is deemed to be the carrying value, of the land. So the revalued amount is the carrying value of the land, and that is the amount that will be recognized. This is the amount that will be recognized in the statement of financial position as at 30th of June 2018. So in the extract of SOPL, extract of SOFP, sorry, if your land and the non-current asset, okay, you will have your PPE, and your PPE just land, right? So that one is going to be 1.7 million, and this is the not 1.7, sorry, 7.2 million, the free value amount. Okay, that's it. Thank you for watching. I hope this helped you with the understanding of the questions on MFRS 116, particularly the question from the common test. We'll proceed with more videos and wait for the videos on the how to do your final exam questions on PPE. With that, I thank you for lending your ears and for lending your eyes to have this video presentation and have session with you. Okay, I'll see you when I will see you. Till then, Assalamualaikum warahmatullahi wabarakatuh.